From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Turmoil continues in the banking sector, which is raising a new question. Are regulators at this point doing more harm than good? And Chinese leader Xi Jinping arrives in Moscow in a show of support for Russian autocrat Vladimir Putin. How worrisome are the growing ties between the countries? Welcome to Potomac Watch. I'm Kim Strassel and joined today by my brilliant colleagues, Joe Sternberg and Kate Batchelder-Odell. So let's start with the banking sector. We're going on like day 10 of problems in that area, and things seem to be just as uncertain. At the moment, this very moment, there are talks led by JP Morgan Chase CEO Jamie Dimon to potentially rescue, again, First Republic Bank. Over the weekend, Swiss officials engineered a forced acquisition of Credit Suisse by UBS, though only after the Swiss government had to provide some $9 billion to backstop some of the losses that UBS would take. And Treasury Secretary Janet Yellen today said that the U.S. might move to cover deposits of yet more banks if there are more runs, a statement that seemed designed to calm, but also suggests there could still be some big problems out there. Joe, amid all this, I guess I'd just make 2 points. One, more than a decade ago after our last banking crisis, Congress swooped in with this complex new set of rules called Dodd-Frank and told us that because of these rules, we'd never have a repeat. So I guess what we're seeing here proves not so much. But the other point is that if Dodd-Frank ever had any merit, it was supposed to be that it was providing some regulatory certainty, some rules of the road, what to do if there were bank failures, new rules on deposit insurance, new rules on banking debt. But if you look around at what's happened since this panic began and what regulators have done in the past week, they're just blowing up all those rules. And I think a good case in point is that Credit Suisse rescue, which I know you followed, which is now causing some turmoil in the market for bank bonds. Can you explain a little bit about what happened there and why it's a problem?
Yeah, Kim. So I think the first thing to understand is that after 2008 and the panic in that year, it wasn't just the Dodd-Frank Act in the U.S. That was part of a much broader global regulatory effort that was all based around the same philosophy of regulation put forward by experts on this issue at the Bank for International Settlements in Basel, Switzerland, the Basel Capital Rules, which were supposed to govern all large institutions around the world, and in fact applied to Credit Suisse, which nonetheless managed to fail over the weekend and be forced into the shotgun marriage with its larger crosstown rival UBS. And I think the philosophy behind that was that the right kind of regulation could manage any important risk that might cause a large financial institution to stumble and threaten any kind of systemic contagion. And we're discovering that's not true because it's just not possible for regulation to manage every kind of risk. So, I mean, it might surprise you to know, actually, that in one sense, the post-2008 rules have worked because we are not stumbling due to the same risks that afflicted the banking system in 2008.
Just new ones.
Right. So the last time we were on this merry-go-round, the problem was credit risk or default risk. You know, banks were holding billions upon billions upon billions of dollars worth of primarily mortgage-backed securities in the U.S. that no one was able to value, that became very illiquid, that created these gaping holes on bank balance sheets. Well, okay, we've managed that. Default risk, the risk that no one controlled for, is what would happen if banks had been operating in an environment of ultra low interest rates for 10 years, and then all of a sudden the interest rates and inflation go up. And it is that dynamic that is creating various forms of squeeze on institutions around the world. And surprise, surprise, the regulatory framework that we developed both to avert that risk and then to tell us what to do if it materialized anyway, in terms of living wills for the banks or the kind of capital ratios they would need to maintain to protect themselves from that kind of 2008 risk. This is turning out to not be adequate, or, worse, politicians and policymakers don't believe that those rules are adequate, so they already are veering from that roadmap. Credit Suisse thing is a great example. Credit Suisse had a living will that was supposed to govern a resolution in case it failed. It had very high capital adequacy ratios under post-2008 regulation. So it wasn't supposed to be in a position to fail in the first place. And yet it did start experiencing pressure from a major deposit outflow. And then the government in Switzerland turned out not to be willing to follow the rules of the living will and allow Credit Suisse to fail. So instead, they orchestrate this weekend shotgun wedding to UBS, which is exactly what we did back in 2008. How many weekends back then did you wake up on Monday morning to discover that there had been another big bank merger or some kind of bailout on Sunday night before markets opened? So there's a real sense of deja vu here where you have the same lack of predictability about what regulators and politicians are going to do in a crunch, which then spills into markets. I mean, now the problem is that investors have no idea what the rules of the road are.
Yeah. And I guess to just add to that a little bit, not to get too deep into the weeds here, but as part of this whole deal that was engineered, Credit Suisse had issued these bonds to cushion itself in the case of a failure, these tier one bonds. And there was always an understanding that that could be wiped out if there was a problem. But under the old bank regulations, shareholders would have endured some of the losses. Instead, they're getting a lot of the money that comes from this takeover, whereas those tier one bond holders are getting nothing. That's a whole big change in the way everybody was looking at things, too. So it's just injected so much confusion into this, and there's probably going to be litigation. So we're ending up with a much messier situation rather than those clear rules of the road. And Kate, I think that this is in a little bit of a repeat of what we saw when federal regulators swooped in at the very start of this to essentially bail out Silicon Valley Bank, saying that it would cover all depositors, even those who exceeded the 250,000 federal deposit insurance limit. And just today, Treasury Secretary Janet Yellen gave a speech and said that the feds may well do it again. Let's take a listen to that.
The steps we took were not focused on aiding specific banks or classes of banks. Our intervention was necessary to protect the broader U.S. banking system. And similar actions could be warranted if smaller institutions suffered deposit runs that pose the risk of contagion.
Wow. So, Kate, that's set off a discussion in DC about a central worry that's growing here now. And the words to encompass it are moral hazard. The hazard of sending a message to depositors. They don't have to worry about their money, even if they exceed that FDIC cap. The government will just cover anything that anyone does, no matter how risky, no matter whatever. Kate, no doubt, Yellen thinks that by making these assurances, she's going to calm people who might be worried and go out and yank their funds from some of these smaller banks. But what kind of message is she sending more broadly?
Well, Kim, I think the risk, as you're describing, is a system in which all deposits are guaranteed. And I think it's worth talking about the problems with that policy, since I think it's being sold as just a sensible consumer protection to ensure all deposits. Tom Honig, who was a vice chair of the FDIC, has given a lot of great speeches about how depositors who are inclined to withdraw their funds when they suspect a bank is unsafe are a check on banks' behavior. So it removes the incentive for discipline, and it encourages risk-taking by banks. And that is the exact behavior that we would like to prevent. I'd also echo what Pat Toomey, the former senator who was on the banking committee, has said also, that if you are insure all deposits, that's really a pretext for political control of the entire banking system. None of this would prevent excessive risk-taking. If anything, it would encourage it. And it also doesn't answer the question of why didn't bank regulators see this coming, given this duration risk was, like we said earlier, hiding in plain sight, that once interest rates went up, these banks could become exposed. So I don't think the deposit insurance is going to solve those problems. And it also creates a really new risk of moral hazard.
Yeah, it just seems like a lot of this is coming back to the regulators and their answers and decisions that they've made since all of this started, which seems to be causing as many problems as the banks have caused in the beginning. Joe, you mentioned, and it made me kind of chuckle, like talked about how a lot of this feels like a repeat of what happened the last time around. And kind of in that category, we've got this consortium, meanwhile, of all these banks that decided they were going to jump in here and rescue First Republic. They dumped a bunch of money into that San Francisco bank last week, some $30 billion, in an effort to restore some confidence in the lender. But this is a bank that the stock market, it's now lost more than 90% of its value this month alone. Depositors have pulled out vast amounts of their money. So now there's talks to go even further and ramp up that rescue. Most of the reporting about this suggests that, Diamond and his fellow CEOs are trying to reinstill some confidence in the banking system. But I guess one question I have is how central is First Republic's health actually to that wider banking system? And given all of these other extraordinary and kind of rule breaking moves we're seeing from regulators, is this the right approach, or is there some merit to letting First Republic fail? What do you think of this effort? Where's that going?
If we're going to call First Republic systemically important at this point, I mean, what a huge indictment of the post 2008 regulatory environment. Because, I mean, the whole point of these reams and reams of banking regulations that Congress and various executive agencies have passed and implemented over the past more than a decade now was to reduce systemic risk. The whole point of it is that you're supposed to be able to allow even a big bank to fail, to have a resolution plan so that it can safely collapse if it comes to that and not filter through to the rest of the economy. And now all of a sudden we discover that we can't survive a deposit outflow at a couple mid-sized banks in California. I mean, it's just ridiculous. And I want to go back to the point that Kate was making about deposits and market discipline in this kind of scenario, because that is an absolutely crucial point. I mean, you can make a good case that banking has become so hyper-regulated and so many people have come to assume that there will always be bailouts that really big money depositors are the only people left in the banking system that actually have any skin in the game. And so they send very valuable signals. And it's notable that actually the deposit outflows have been concentrated in banks that turned out to have legitimate concerns about the stability of their balance sheets that need shoring up. We should be paying attention to that. And I think that we should also be encouraging more of what seems to be happening with First Republic right now, which is a private sector effort by other banks to step in to stabilize the situation before you end up in a situation where the government is putting the taxpayer on the hook to try to either arrange a deal from Washington or put taxpayer cash behind various guarantees to make a deal like that happen.
Yeah, I totally agree with that. And I'd like to see more of it rather than all the wailing that has come instead from some of these depositors and that has inspired regulators to instantly step in and put taxpayers on the hook for their bets.